Hey Top 10 Army, what's up? Welcome back to another amazing episode of Top 10 Center. I am back with another lit video and I'm sure you'll enjoy this. So guys, in this amazing episode, we are going to discuss investing mistakes you should avoid as a beginner. Are you guys excited for this amazing video? Before we begin, make sure you like and subscribe to our channel. We bring you the latest news and updates in the finance and business world. It won't be a wrong thing to consider investments and risks synonymous, as you can simply lose it all with just one wrong move. From following the trends to losing your cool in days, here are some rookie mistakes that you must avoid to be better in the world of investments. Number 1. Not understanding the investment. One of the world's most successful investors, Warren Buffett, cautions against investing in companies whose business models you don't understand. The best way to avoid this is to build a diversified portfolio of exchange-traded funds, ETFs, or mutual funds. If you do invest in individual stocks, make sure you thoroughly understand each company those stocks represent before you invest. Number 2. Falling in love with the company. Too often when we see a company we've invested in do well, it's easy to fall in love with it and forget that we bought the stock as an investment. Always remember, you bought this stock to make money. If any of the fundamentals that prompted you to buy into the company change, consider selling the stock. Number 3. Lack of patience. A slow and steady approach to portfolio growth will yield greater returns in the long run. Expecting a portfolio to do something other than what it is designed to do is a recipe for disaster. This means you need to keep your expectations realistic with regard to the timeline for portfolio growth and returns. Number 4. Too much investment turnover. Turnover or jumping in and out of positions is another return killer. Unless you're an institutional investor with the benefit of low commission rates, the transaction cost can eat you alive. Not to mention the short-term tax rates and the opportunity to cost of missing out on the long-term gains of other sensible investments. Number 5. Attempting to time the market. Trying to time the market also kills returns. Successfully timing the market is extremely difficult. Even institutional investors often fail to do it successfully. A well-known study, Determinants of Portfolio Performance, Financial Analyst Journal 1986, conducted by Gary P. Brinson, L. Randolph Hood, and Gilbert L. Biebauer, covered American pension fund returns. This study showed that on average, nearly 94% of the variation of returns over time was explained by the investment policy decision. Number 6. Waiting to get even. Getting even is just another way to ensure you lose any profit you might have accumulated. It means that you are waiting to sell a loser until it gets back to its original cost basis. Behavioral finance calls this a cognitive error. By failing to realize a loss, investors are actually losing in two ways. First, they avoid selling a loser, which may continue to slide until it's worthless. Second, there's the opportunity cost of the better use of those investment dollars. Number 7. Failing to diversify. While professional investors may be able to generate alpha or excess returns over a benchmark by investing in a few concentrated positions, common investors should not try this. It is wiser to stick to the principle of diversification and building an exchange-traded fund or mutual fund portfolio. It's important to allocate exposure to all major spaces. In building an individual stock portfolio, include all major sectors. As a general rule of thumb, do not allocate more than 5 to 10% to any one investment. Number 8. Letting your emotions rule. Perhaps the number one killer of investments return is emotion. The axiom that fear and greed rule the market is true. Investors should not let fear or greed control their decisions. Instead, they should focus on the bigger picture. Stock market returns may deviate wildly over a short time frame, but over the long term, historical returns for large cap stocks can average 10% over a long time horizon. A portfolio's returns should not deviate much from those averages. In fact, patient investors may benefit from the irrational decisions of other investors. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also, watch the 2 videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.